The 5 ways to profit from the big tech earnings. Everybody know or should know. You're probably going to hear about this tomorrow morning. Big tech, the big tech companies like Facebook, Amazon, Apple, Google, all released their earnings after hours today. And I'm going to show you 5 different ways to profit from their earnings. And I'm going to go from a conservative all the way to the most riskiest. So you know, the more risk you take, the more the greater the reward. Anyway, right? But you guys and girls got that. So today's topic, we're going to talk about the 5 ways you can profit from the big tech earnings. But first, hit the subscribe button, hit the bell icon, hit that like, comment, and share button. Once again, ladies and gentlemen, boys and girls, and children of all ages, you're now tuned into the Investor Show as always. This is your gracious host, the Prince of Investing, Prince Dice, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button. And as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. So, ladies and gentlemen, earnings reports. Earnings reports are so important because this is the time of the year or the quarter that we get to see where the companies get to put up and shut up or shut up, whatever you want to say. They shut up. We don't want to hear about all the good stuff you've been doing. We get to open up those books. We get to see those numbers. We get to see what those companies are really earning, right? And we get to get a projection of the future. So this is why earnings reports are always so important. And what has really been carrying the stock markets lately? This year, 2020, has been a year of tech companies. Companies like Facebook, Amazon, Google, Apple have been pretty much carrying the market. Tesla has pretty much been carrying the market this whole year, during the year of the pandemic. Of course, you had some consumer staples like Coca-Cola, Procter & Gamble. There's also Clorox had a great year for obvious reasons. But, tech companies been doing their thing. So this is a rare time. It's very rare that you see all these companies come out on the exact same day. Usually they have the same week or maybe a week apart or something like that. But it's very rare you see all these companies come out. Netflix already came out last week. And then this week on one day you see Apple, Facebook, Google, Amazon, all the same day, bringing a great opportunity to investors. So I'm going to talk about these great opportunities. I'm going to break them down. So when you have all these companies coming out at the same time, I'm going to first pull up one option, the least riskiest thing that you can do when investing, right? Uh, when you have all these companies coming at the same time, all these companies are tracked by the NASDAQ, and the NASDAQ ETF is followed by QQQ. That's Quebec, Quebec, Quebec. And these are all the companies these track all the NASDAQ companies. So it's very rare. If all these companies do good, man, this thing is going to go through the roof. When all these companies do bad, this thing is going to sink down, right? But the thing about it, what makes this less risky is that it's doing the whole entire NASDAQ. It's very likely that one or two companies were missed, but for all the big tech companies to miss at one time, it's very unlikely. So one way you can invest is to say, hey, boom, I want to jump into the QQQ before the earnings come out. And you can do a little bit after, because as of right now, the NASDAQ is rallying, and we're going to see that rally kind of continue. Now, the next thing you're going to talk about is we're going to look into a leverage. We're going to look into a leverage ETF. This is a bearish ETF, right? Not a bearish, but it's a bullish ETF on the NASDAQ called TQQ. This is Tango, Quebec, Quebec, Quebec. This is this is a leverage ETF, meaning that if the stock market goes up 1%, if the NASDAQ goes up 1%, this will go up 2% or 3%. So this is leverage. I know that, this is more riskier than just buying the index. So if you want a little bit more risk into it, a little bit more risk involved, you can get the TQQ. So if the NASDAQ does go up, the QQQ, the index that I showed you earlier, it's going to go up a little bit, but this is going to go up a little bit more if you get the TQQ, right? Now we're going to get into the next option. Say, Prince, if I'm right, I really want to be right. So we're getting riskier and riskier as we go down. The next option is called a call option on the QQQ. Now, yes, a call option is giving you the option to be able to buy the NASDAQ for a particular price, right? The ETF that tracks the NASDAQ for a particular price. So for prime example, let's walk through it. The index may move 2%. The leverage bullish bearish ETF may move 4 to 5%. But a call option on the index may move 10 to 20 to 30, maybe 10 to 20%, depending on how risky you got it, right? So now you can see, hey, if I get a call option, but let's look at the downside. If you're wrong on the index, the QQQ, you're just wrong for the day. You can hold on that ETF and it'll probably fix itself in the future. If you're wrong on TQQQ, yeah, you're going to get hurt for the day, but you can hold on to it. Even though it may take a little bit longer, you may hold on to it to where the NASDAQ picks itself back up. But if you're wrong on a call option, depending on your expiration date on a QQQ, now this is when it becomes a little bit risky. But if you're right, you can make anywhere between 30, 40, 50, 100% or whatever. Most likely, you probably can make somewhere between 20 and 30% overnight. But if you're wrong, you're going to lose probably about almost whatever you put into the investment. So that's the riskier side of it. Now we're going to get a little bit more riskier. Boom. A call option on a leverage ETF. You saw we spoke about earlier that I have pulled up the TQQ. You can buy a leverage ETF on the TQQ. Now, call option on the index may move 30%. If the call option on the index moves 30%, the call option on the TQQ is probably going to move 50 to 60%, right? So, but then again, if you're wrong, you're really going to be wrong. But this is a call option on the leverage ETF. Now we're going to get to the most riskiest thing you can do. The most riskiest thing you can do is to pick a company to buy a call option on. Now, I forgot the most least riskiest thing under the index. Another you can throw in there. You can just buy Apple stock. You can just buy Amazon stock. You can buy Facebook stock and forget about it, and may make a 5% return the next day. Or if the companies drop down very drastically, this is a buying opportunity for you. So picking a company and buying a call option. When I said the most riskiest thing you can do is to pick a company like, oh, Amazon is going to go up or Apple is going to go up. That's the most riskiest thing you can do because all of this is weighing on one company's earnings report and not even what their earnings reports say. Their earnings report could be good. Like Amazon had good earnings last quarter, but guess what? They also put out they was going to put $4 billion to the coronavirus relief. When they put out those $4 billion, it hurt everybody, right? It hurt everybody with the call option. I mean, it hurt the stock went down 7%. So by buying a call option on one company, that makes it more riskier versus the index. Guess what? I know Facebook may be right or wrong. Amazon may go up or down. Apple go up or down, but the likelihood that all these companies are going to go down and drag down the NASDAQ is less likely than, let's say, Google misses its earnings report. So Google, Facebook, Apple, all these tech companies are coming out at the same time. This is a good time. Hey, like 1, 2 to 3% of these, 1, 2 or 3 of these companies are probably going to carry the entire index. So picking one company, you up your risk. By buying a leverage ETF, of course, it's going to up your risk because you have to pick a side. The way you can pick the bull side, you can pick a bear side. And it may sting a little bit, right? But we always know, I always say, the bull will win the bull will win the war. But the bear, sometimes he will win the battle. So the bear will win the battle, meaning in the short run, but the bull will win the war. So in the index, you're going to win in the long run on the index. But every now and then, you're going to see that bear come around and win some on the downside. So these are 5 ways. We're going to do a quick recap. First, you can pick the index, pick the NASDAQ. Big tech companies, the NASDAQ track them all. You can just buy the NASDAQ, right? Buy NASDAQ QQQ. The second option you got is a leverage ETF. If you think NASDAQ is going to go up, you can do a Tango QQQ. You can just say, hey, I think the whole index is going to go up because of big tech. Another thing you can do is you can make a call on QQQ. It's a little bit more riskier. Making a call option better than it's going to go up. Next thing you can do a call on TQQ to put a little bit more leverage that you're betting is going to go up, right? And the most riskiest thing you can do is to buy a put option on a particular company. So hopefully this kind of helps. Hopefully this breakdown kind of helps here a little bit, give you some options, some tools to put in your toolbox. But anyway, my name is Prince Dykes, and until the next video, podcast, cartoon, or whatever else crazy you see me do around the globe. Peace, be safe. I'm out, and thank you.